Okay, good afternoon, everybody. This is Professor Hassey. It's Friday, May 19th, and this is our weekend update video for Business 630. And two purposes of this video this afternoon as we head into the final weekend of week 7, heading into our final course week. We're going to review alternative strategies to capital financing. And the reason why we're doing that is we don't have a specific case. Case 3 and the electrics case are not specifically asking questions about alternative corporate capital strategies like mergers and acquisitions and leasing. But if you happen to reject the electrics case, in other words, if you reject for whatever reason that you interpret in your analysis, the two types of alternatives for products for the electric case. Another way that the electrics case can be, or electrics company can be recommended by you is to merge with another company with those products or find alternative financing to help them supplement the investment and reduce the risk of those products. So in some respects, indirectly, this last week 7 does have something to do with the analysis of financial management interpretation, even though there's no direct assessment in our course about that. But it's still important to know. So I'm going to show you a couple of videos in regards to this. They're a little dated, and I hate it when professors show videos that are 20 years old or 10 years old. It's really cheesy. But of all the videos that I see about mergers and acquisitions, these are the two best to describe what we need to describe for this week 7, the basic definition, and what is mergers and acquisitions. So that's why I selected them. So again, it's even though they are a little cheesy and even though they are a little bit dated, I still think they give us a basis for understanding of mergers and acquisitions. So once we look at those videos, and then we'll take another look at another perspective of the electrics case. Today, we're going to be talking about the warranty calculation a little bit more depth. And then on Saturday, this weekend of week 7, Saturday, May 20th, we have a review session at 1 o'clock via Zoom where I'll have a half-hour discussion on the electrics case, concentrating mainly on the paper. And then also, if for anybody who does come on that Zoom, ask any questions about case 3 and the electrics case. So that's where we stand coming into week 7 of our course. So let's take a look at alternative sources of capital.
Mergers and acquisitions, or M&A, refer to the consolidation of companies through various types of financial transactions. Although they're often used interchangeably, they mean slightly different things. A merger occurs when two companies combine to create one organization. For example, Exxon and Mobil merged in 1999 to form a new company, ExxonMobil. An acquisition, on the other hand, refers to the purchase of one company by another where the purchasing company obtains majority ownership in the target company. For example, Amazon acquired Whole Foods in 2017, but both companies preserved their names and organizational structures after the deal was finalized. Over the last century, there have been multiple waves of M&A activity in the U.S. The recipe for M&A usually involves cash-heavy companies and low interest rates, allowing companies to more easily pay for deals. Also, when demand for their goods and services is slow, companies might look to grow through M&A rather than organically. Conversely, high interest rates and an unfriendly regulatory environment have the potential to slow down M&A activity. Companies do M&As for a number of reasons: to increase performance, decrease costs, diversify their business, or to grow market share by buying a competitor. Do all mergers and acquisitions work out for the best? Not quite. In 2001, America Online combined with Time Warner in a massive $165 billion merger. The new company, AOL Time Warner, sought to capitalize on the convergence of mass media and the internet. Shortly after the merger, the dot-com bubble burst, causing the company's AOL division to lose significant value. In 2002, the company reported a massive loss of $99 billion. In an acquisition, once plans are made public, the acquiring company's stock price typically declines, while the target company's stock price often rises near the expected deal price. But this isn't always the case. When Amazon agreed to buy Whole Foods for $42 per share, Whole Foods jumped from $33 to $42, gaining more than $9. Amazon's stock also gained, opening $32 higher. As a shareholder, the decision to hold or sell a stock before a deal is final can be tricky. It's always possible that the deal may fall through, likely erasing any gains. However, other companies may jump in and bid a higher price for the target company. This may result in a bidding war and drive the stock's price even higher. So what happens if you own stock in a company being acquired? You could receive cash for your stock, a combination of cash and stock, or another form of compensation. It's important to note that every deal is different. Be sure to check the investor relations page of both companies and contact your broker with any questions. With any trade, there are always inherent risks. Trading companies involved in mergers and acquisitions could result in a substantial profit or a substantial loss in a short time frame. Make sure you do your research and assess risk before making a decision.
This video segment discusses mergers and acquisitions in the context of strategic management. Merger and acquisition activity is extremely important in strategic management as we continue to see larger and larger deals in front of us. One of the more recent in the acquisition area is that of Google's proposed acquisition of the Motorola cell phone business for $12.5 billion. This signals Google's desire to further diversify away from its search engine business into an area it thinks has great potential for profits. It's instructive to differentiate between merger and acquisitions because they are quite different. In a merger, what you'll have is two firms of somewhat similar size that just combine their assets, and their names typically become combined as well. You may recall the failed merger some dozen years ago between Daimler and Chrysler. Their names became merged. Acquisitions are quite different. This is a situation where you find a larger or more cash-rich firm buying a smaller organization. The smaller organization then comes the subsidiary of the larger organization. If the Motorola acquisition goes through, Motorola will become a subsidiary of Google. In the not too distant past, Kraft paid $20 billion to purchase Cadbury. Kraft is a United States convenience food manufacturer, and Cadbury is a confectioner into chocolates and chewing gum, and they are located in the United Kingdom. Kraft paid almost $20 billion to purchase all the assets of Cadbury. In the business press, we quite often see merger and acquisition activity discussed interchangeably, but these terms mean something very different, as you can see from this and from this slide as well. In the situation of mergers, you have a situation where either the names become combined or one of the parents may become the dominant player, and they're simply named after the larger or the more dominant organization which comes through in a merger. One of the parents, regardless of how their name changes or does not change, usually emerges as the dominant management team. I don't know what the case in Sirius XM radio is, but I do know that Daimler, a German company, became the dominant management team of Daimler Chrysler some years ago. In acquisitions, you have a situation where the acquirer, which was Kraft Foods in this case of Cadbury, just buys out all of the firm's stock. So they bought all of Cadbury stock for nearly $20 billion. And these types of activities can be either friendly or hostile for the acquiree. There are several types of merger and acquisition activity, and I'm going to detail 5. Vertical activity in mergers and acquisitions could be simply to buy a supplier or customer. So they're vertically going forward or backward to streamline their cost structure. And Johnson & Johnson acquired some time ago Mentor, which is a latex glove company, among other things, to complement its products to become a supplier to other divisions of Johnson & Johnson, hence streamlining its cost structure. In the case of horizontal merger and acquisition activity, we see a situation where you merge or acquire a competitor. And we've seen that in the recent past, in so much as that the Dutch firm InBev bought out Anheuser-Busch, thus reducing their competition to some extent. Product extension is a situation where you're buying complementary products or acquiring them to fit your portfolio. And in this case, Kraft's acquisition of Cadbury is a perfect example of complementary products. It also exemplifies market extension, which is where you want to go into different markets. If you studied the Cadbury Kraft acquisition, probably the main reason that Kraft wanted Cadbury so badly is that Cadbury does very, very well in some emerging markets where Kraft does not do very well. And namely, those two markets are India and Brazil. Cadbury does very, very well there. Kraft has had minimal success and hopes to piggyback off Cadbury's leverage in those two large emerging economies for Kraft to do well. And that's market extension. And then there's also this unrelated firm of merger and acquisition activity. We call it conglomerate merger and acquisition activity. And this is a constant strategy that General Electric undergoes. General Electric, if you look at their web page or their annual report, they are into a wide host of products, from light bulbs to appliances to jet engines to medical imaging products in the healthcare industry, and many more industries as well. So it buys firms that are quite different, but at the same time it diversifies their total risk by being involved in a lot of different industries. The logic behind this related merger and acquisition activity, when you buy something that's related or you merge two firms that are related, what you hope is that you have value creation, and that is what's hoped from the merger between Sirius and XM. They need to create value because both firms were losing money, and we examine this when talking about the value chain. Part of that value creation is going to come from cost reductions, hopefully through economies of scale, or a larger new satellite radio organization being the new merged company. And also another value creating activity we see called economies of scope, and that is situations where firms can share competencies. And really this goes back to the value chain as well. They can share branding, name, content, subscribers, etc. There are some implementation issues in mergers and acquisition activity. No better illustrated than in the case of Daimler and Chrysler. And that's in cultural differences. A German organization merging with a US organization. Merger and acquisition activity always requires the merging of two different cultures, whether they be from two different countries or from the same country. You're still going to have two different and often quite disparate organizational cultures. That was a big problem for Daimler and Chrysler. Cultural merging involves a number of things. Among other things, it involves the combination of elements of two different cultures, management styles, products, customers, etc. It's interesting to see what's going to happen if the Google acquisition of Motorola happens and the Kraft acquisition of Cadbury, as of this speaking of late 2011, is already complete, and we still have not seen yet the full effect of the combination of both cultures. We do know in the case of Kraft that Cadbury has fought this over in the United Kingdom because they're not happy about an American company buying out their company, and many are unsure about their stability as an organization going forward. Thinking Kraft might take the chocolate company and move it back to the United States. So it's difficult, costly, and it's not always possible to pull off a merger and acquisition from the implementation side. One last thing I'll say is that merger and acquisition activity is kind of risky, but it's especially risky in the international side. Research shows that 70% of all mergers or acquisitions that take place between firms from different countries are going to fail. So if you think about that, your odds of making a merger or acquisition work when you have headquarters from two separate countries, your odds are not very good.
Okay, two good, short but sweet videos explaining mergers and acquisitions and the different types that there are. And it gets quite confusing if you think about it of all the different varieties, but it's fairly simple. It's basically a company needs capital. They've run out of resources for that capital, so they seek to go out and find that capital by either merging or acquiring other companies. Now, the complications exist when you have two companies, and that can get complicated. A couple things I want to show you in the Blackboard. Okay, let's go back and look at the electrics case. I'm going to talk a little bit about leasing as alternative capital resources in my intro video to week number 8 on Monday, May 22nd. So I will take up some time in that video to go over some key important parts about leasing as it fits into capital strategies in regards to our course. This week, mergers and acquisitions. On Monday of week 8, we'll talk a little bit about leasing, which is important, as a lot of you I know lease products instead of purchasing assets. So we'll talk about that in our week 8. But let's spend a few moments on electrics, which we'll have a review session Saturday afternoon. Well, excuse me. Will I'll be able to go and answer any questions. Also, some of you have already given me your drafts of some spreadsheets, and I've given you feedback. But I want to concentrate on a couple of things. First of all, the setup in your spreadsheet. Remember, let me just go there right now. Remember in our Blackboard, in our checklists part in the electrics case file folder in Blackboard, where I gave you a checklist of key things to find out and review. Remember, we have to have 9 tabs in our spreadsheet that you're turning into me. A tab for weighted average cost of capital, a tab for the warranty cost calculation, a tab for your depreciation schedule under marginal accelerated cost recovery for an 8-year asset life investment, the average analysis for the product CTX. Now, the average analysis is like the base analysis that you did in case number 2. Then a scenario analysis, just exactly like you did in case number 2, but on a separate tab so I can see it separately. A sensitivity analysis, just like you did in case number 2 for this product. But remember, the sensitivity analysis is a little bit different, and I'll talk about that in just a minute. Now, many students are asking, Mr. Hassey, do I need to have a graph in that analysis? Well, if you just copy over the format of case 2, you can have a graph. Excuse me. But if you desire not to include a direct graph, it just give me the columns of your calculations. That's fine as well. Then you're going to have a tab for the other average analysis with the other product, MT78, and then another tab for the scenario and another tab for the sensitivity. So 9 separate tabs in the file that you give me. If I see 8, if I see 6, if I see 12, and not 9, points will be taken off in regards to the presentation of your data. So please remember that as you go forward in setting up your spreadsheets, all right? Now here's the solutions for case number 2 with all of you completed. And notice this is an average or a base analysis of this investment of $700,000 over a 7-year life. Our electrics case is 8 years, but the format is basically exactly the same. You calculate your investment and your working capital for year 0. You anticipate and calculate based on the variables, the sales, the expenses, variable, fixed, depreciation. You take into effect the tax, you come up with the net income. There's no salvage value in the electrics case, so you don't have to worry about that line. You add back in depreciation, you take into account the working capital, and then you can determine the discounted cash flow with the WACC that you calculated prior and give the 4 key areas of analysis: NPV, IRR, PI, and payback. Now you need to do this for both products, and that's where you need to be very precise in your variables. Now, another thing to give you a helpful hint, and I'm going to go now to our case information. Now, here's the exhibits given to you in the case where you get your variables and your information to do the analysis like we just saw in case number 2. The average or the base case is what you do the main analysis. Notice the average case has a $9,200 per unit sales with 40,500 units sold every year. That's a big number. The variable costs are labor costs per electric motor, the parts, $2,500, and if this is a CTX 13 analysis, the price of the controller, $1,280. So those are your 3 variable costs. But then you have a second variable cost, which I urge you to do a separate line on, and that is the warranty cost. The reason for that is the warranty is going to be, the dollar amount per unit is going to be the same in every year 1 through 8, because that dollar amount every year 1 through 8 is going to include 5 years of warranty. For the case of the CTX 13, $75 and $90. $75 for the motor, $90 for the controller that runs the motor. That's $165 every year for 5 years. And then you discount that into one number, and that number will be your cost, variable cost per unit, per the warranty for every year, times the number of units nationally you're producing. So I urge you to keep that on a separate variable cost line. The reason for that is because you're going to have to do a sensitivity number on that as well. And I'll talk about that in just a minute. So to ease your burden, keep those variable costs separate. It makes it a lot easier in your analysis. For the MT78, your variable cost warranty per unit for 5 years, every year is $175 for 5 years, discount that, and there's your number. So this is where this differs. The variable costs of labor, parts, and the actual controller installation, those costs are one lump number per unit. But also those are going to inflate every year at your inflation rate. The warranty cost line is separate because you should include the inflation in your 5-year cash flow that you're discounting to come up with that discounted cash flow number, which will be your warranty rate. So you include the warranty in that discounted cash flow analysis for your warranty costs. And then that is the reason why there'll be that's going to be the same amount every year, 1 through 8 for warranty, whereas the variable costs for labor, parts, and the controller are going to inflate at 3% every year. That's why you keep those on separate lines. The inflation has a different calculation for those two. It is confusing, but that's why you're an MBA student, to try to sort this out and present it. Then when you do your scenario analysis in another tab, your scenario analysis will include the weak and the strong in that scenario calculation for NPV, like we did in case number 2. And in regards to the sensitivity analysis, let's go back to the highlighted questions on page 4 that you need to ask or answer in your paper. And I will concentrate on these 8 questions in my review session on Saturday afternoon. But one thing to note is question number 6, where it's given to you the percent of deviations of your sensitivity of 10, 20, and 30. Remember in case number 2, your sensitivity analysis was 30, 10, and 10, 30, 20, and 10 as well. So you can use that as your template in doing the electrics case. So 10, 20, and 30 is your deviations. But here's the catch. In question 6, it says, use the average demand scenario or the base case, just like we did in case number 2, to evaluate the sensitivity of the project's net present value with respect to sales price of the electric motor and the cost of the controller. Remember in the case number 2, you had 3 sensitivity variables: the selling price per unit, the variable cost per unit, and the fixed cost. Now, in this case, you have two. One is pretty obvious, the sale price of the electric motor. That's pretty well given. The second one requires a little bit of thinking. The cost of the controller is your sensitivity number. Well, here's the cost of the controller per exhibit 1 and 2. The cost of the controller is $1,280 plus the warranty of $90. So what you're going to have to do is you're going to have to determine the sensitivity variable amount by recalculating the variable cost, not for your base case analysis, but for your sensitivity analysis. The sensitivity variable is the cost of the control. What's the cost of the controller? It's $1,280 plus 5 years at $90. For the MT78, it's $1,260 per unit plus $100 for 5 years of the warranty. So you're going to have to combine those just in your sensitivity analysis. Do not include the average warranty cost here. You're going to have to calculate the sensitivity variable for the cost of the controller, which includes both the variable cost price for the controller and installation and the variable cost of the $90 over 5 years for the warranty. That's where that gets a little hairy and requires a little bit more thinking and analysis. So that's a heads up for that sensitivity calculation. It's the selling price per unit, and the second sensitivity variable in your analysis is the cost of the controller. There's no fixed cost like in case number 2. So going back to case number 2, a couple of different things to add or subtract from the case number 2 spreadsheet template that you did in case 2 and adapt it to the electrics case. Number 1, it's an 8-year life, not 7. Number 2, there's no salvage value, so you don't need that line. Number 3, I would have 2, maybe even 3 to keep it simple, variable cost lines. A variable cost line for the parts, labor, and the controller, and a variable cost line for the warranty calculation. But knowing the information that you need for the sensitivity variable, why don't you combine and have, here we go, 4 lines of variable cost. A variable cost for the motor, a variable cost for the controller. So the variable cost for the motor would be the parts and the labor. The variable cost for the controller, which would be that 1280, 1260. The variable cost for the warranty on the motor, and the variable cost on the warranty on the controller. When you have all that information on 4 lines, that makes getting the data for the sensitivity variable for the cost of the controller much easier. Give you a little helpful hint on that. So to make it easier on yourself to do the risk analysis for electric case, why not have 4 variable cost lines? Fixed costs would be the same, the numbers would be different, depreciation, and so on. No salvage value. So that's just a little helpful hint in setting up your spreadsheet for the electrics case. Clear as mud, huh? Well, that's why we have the review session on Saturday. And that's why I'm available to look at drafts as you get it ready prior to its being due on May 28th. So that's our weekend update for this Friday, May 19th. A little discussion and analysis of mergers and acquisitions, and some more helpful hints in setting up your spreadsheet analysis for the electrics case. On our review session on Saturday, May 20th, I will concentrate my review on the paper aspect of the electrics case, and also welcome any questions you might have. Again, I will record the video of the review and post it to Blackboard. And then we start week 8 with a video on Monday, which will talk about leasing and maybe go over any final points of the electrics case. Remember, you have case number 3, the PowerPoint file, which is due this Monday night, May 21st. If you need an extension in a couple extra days, feel free to ask, but you need to ask and get approved. There is no extensions for the electric case. Everything needs to be posted. Your APA format file and your spreadsheet analysis with 9 tabs of data is all due on Sunday, May 28th. All right, everybody, have a great weekend. Maybe I'll see some of you in the review session on Saturday. And until then, adios.